Hey traders, Todd Gordon of tradinganalysis.com. This is the free video for Tuesday, July 29th. I got a lot for you, so buckle in, hold on to your hats. Okay, this is my lucky Vegas trading hat. So what we're going to look at here today is the SPY and the Russell. There's a lot of talk about small cap divergence relative to the S&P. I'm going to show you exactly what's going on with this. So here we go. This is the chart I put up for research clients today. In orange is the SPY, and white is the IWM, which is the Russell ETF. Below is the ratio. You take the IWM, you divide it by the SPY, and you get a ratio, and you see the relative performance of those two markets. And what you'll see is back in 2011, the ratio, okay, we're rallying up into the kind of late 2010 high, which meant small caps are outperforming the S&P, which is good in an upswinging economy. We kind of bumped up against a 63 level in the ratio. Then what happened is the S&P came off. The ratio reset, found a low, and then the two began to rally. And now we're starting to get up here. You'll see that green indicator moving higher. The Russell was outperforming, but then again, we ran into 63.5, and then we sold off. But this time's different. Look, the S&P has not sold off yet. In fact, it just continues to go higher. So there's one of two things can happen to get this ratio back up off of these lows, off of this like 56, 57 low in the ratio, continue to go up. So there's two things. S&P can come off, Russell can come up. We're long Russell. We've talked about it. We put it up in the video, and here's the chart. Russell on the daily, we have this as A wave, here's a B wave, and we think we're just going to have one more little C wave move down. It's about 1080 in the Russell. I've overlaid the IWM over here on the left. It's about 109, 108 in the IWM. So here's the trade we're looking to put on. Let's go over to the DOE platform. I want to show you that we're actually looking to add to this long position to play for the ratio to move back up from that 57, 58 level up into the 60s. I think the Russell is going to find a low and move higher. So here is the DOE platform. Trade we're looking to do is out in September, and because it has a IV rank, which is Thinkorswim or Sosnoff and DOE's kind of proprietary IV range rank thing, it's very good. It will, above 50 is good to sell. It's about 38 right now. We'd like to see the Russell move a little bit lower, and I think we'll see that implied volatility move up above 50, and we can get a little bit more for this trade. So the trade we're looking to do is actually be short a one standard deviation put credit spread. So the one standard deviation for the September options is right here on this dotted line of 105. We'd sell the 105s, buy the 100s for a $5 wide spread. This trade has about an 84% chance of success. But remember, we're matching up with Elliott Wave and good technical analysis. So the 105 is down here. We should not come anywhere near this level because wave 4 is in play. Once we found a low in the C wave, we should be rallying up in wave 5 to new highs in the S&P and the Russell. So I think the trade has a higher than an 84% chance of success. So we're going to be looking for the Russell to sell off a little bit towards 1100. And then again, what we're going to do is sell the 105s in September, buy the 100s. Right now you get 55 cents for it, but if you wait a little bit longer, you can get a little bit more for it as that implied volatility should go up. So again, we're not throwing in the towel in the small caps like everyone else. We're long. We're looking to add to it. We think stocks go to new highs, and that's what we're looking to play in a higher implied volatility environment that we've seen in the Russell, which is not being seen over in the S&P and the NASDAQ. So use that kind of fear in small caps to your advantage, guys. Good luck. Hope that helps, and see you on the next video update.